Vlad here with a video on how to trade the first presented fair value gap after 9:30 and something else. But first, how to trade the first presented fair value gap after 9:30. There are several important things that you have to keep in mind. First of all, you have to have a bias. You have to have a draw on liquidity which you will be targeting. Second of all, your ideal entry will form um, during a macro, and also you will want. So there are several ways to trade this, but this is a conservative way that Michael shared in his Telegram, and I think it's very, very powerful because it filters out a lot of fake signals and fake runs, and I think it's gonna help you with your FOMO. It's gonna help you with your over trading and over leveraging and fear of missing out everything. Uh, it's gonna help you with your psychology because you know that if it's not there, you don't touch the chart. Okay. So this first is just a basic screenshot of what we will be looking for, and then we'll see several examples that happened over the past few days, where this logic, if applied correctly, um, can reap great rewards for you. Okay. So whether you are trading fair value gaps or imbalances or order blocks or anything, whatever your model is, you will want to look for this same logic. You can blend it. I'll show you with several other concepts to modify your model, trade not just fair value gaps, but other PD arrays as well around the first presented fair value gap. Okay. So first of all, very important, you have to have a narrative. Okay. Our narrative here, our drawn liquidity is this buy side. It's relative equal highs um, on the left side of the chart. I'm not going to show them here, but trust me when I'm telling you, they are there. Very obvious relative equal highs. They are the initial drawn liquidity for the morning session. Then, what are we looking for? Initially, from 9:30 open, we want to see some sort of manipulation down, right? Think of it in terms of open, low, high, and close, or accumulation, manipulation, distribution. So if that's your accumulation here, you have the manipulation down after 9:30, and then distribution. Okay, so open, low, high, and close. Okay, that's your pretty much your 10 o'clock hour from 9:30 to around 11. So the model looks like this. Whenever your first presented fair value gap forms, and you're bullish, you want to see first a displacement above this first presented fair value gap. Okay. Then you want to see price retest the gap, so trade back into it. But you want to see it fail to close the gap with candle bodies. Okay, so on a closing basis, it has to fail closing below the low of this initial first presented fair value gap after 9:30, and then displace again. Okay, then you're looking for another displacement. If you're trading a fair value gap, you will look for another displacement up. Okay, and that will be the second displacement up will be your entry. Okay, so first we have a displacement here. Look, single pass through the first presented fair value gap. Then we have another BC here. So price is leaving inefficiencies on the way up. Okay, It's closing the gap, and as it's going up, it's leaving inefficiencies. Okay, that's what we want to see. Then, when it goes down to retest the first presented fair value gap, we want to see it fail to deliver the low of the gap. Okay, that's ideal. Now, after it fails here, what is it doing? It's going up, leaving a displacement right here. First BC, second BC. That's exactly what you want to see. This here is an entry. If we trade into it, that's an entry. Okay. This is how you use the first presented fair value gap. Now, in this specific scenario here, we don't trade back into these BCs. These are breakaway gaps. But what else do we see here? There is a volume imbalance, which we trade through here. So on the way down here, whenever this candle opens and trades down, you can use that as an entry. Okay, to ride this wave up. Most of the time, you will see a fair value gap that we will trade to, and then price will start spooling. What else is here? We have our 10 o'clock macro. That's what you want. These setups will form around macro times for highest probability. They may work outside of macro windows as well, but definitely the probabilities will be a little bit lower, even though I've seen massive moves that originated around the first presented fair value gap outside of macro window. Okay. But usually the macro will be the one that will push the price down into the first presented gap, and then it will react and fly into the sky. Okay. Another thing here that's very key, we have our 2022 model. This here is a change in the state of delivery. Sorry, it's a market structure shift, not change in state of delivery. This is a market structure shift. Displacement up. Here's your breaker. Trading up above the breaker, then going down. This here is a balanced price range. It just so happens to overlap with the first presented fair value gap right at 10 o'clock, and then we go up. So that's your ideal entry. If you want to be a little bit more aggressive, not so conservative, to wait for another displacement. Okay, so now that we have this out of the way, let's see an example. Let me first remove this old gap. Okay, so here we are on March 19th, morning session, and this is 9:30 here. Our first presented fair value gap is here, forming in 934. It's a rather small gap, but it's still delivering very good. We have a similar scenario here. Price initially goes down, then we have a market structure shift. This is your breaker, so we trade above it, leaving an inefficiency. That's your unicorn model. Here, 950 macro, price starts pulling up. So if you want to trade this initial move up, you can do so whenever this single candle here closes above the midpoint of the gap. So let me make it larger. Okay, then as soon as this candle opens, you expect that aggressive move up. But for more conservative traders, you can be a little bit more patient and wait for another setup. So price goes up, then rolls over at 10:30 and start going down, delivering back to the first presented fair value gap. It stops one tick above it, okay, here, just a tick above it. But there is something else that it actually touches, and that's the opening range gap. Since the opening range gap is not the main focus of this video, I'll just show you here. It touches it, um, but just to know that the opening range gap, you can use the same logic when you have a clear bias and arrive at the same type of setup. Here, the first presented fair value gap and the opening range gap pretty much overlap at the top here of the opening range gap. So price here touches the opening range gap. It fails to deliver for one tick to the first presented fair value gap, but you can trust that. And then it displaces. So here, initial displacement is here on the left, goes down, touches it. What time is it? 10:55. So that's the next macro window. Then another displacement. This here is a breakaway gap. Ideally, we want to see that stay open. Why it is a breakaway gap? Because we have a consolidation and then price leaves the consolidation, leaving a gap. That's a breakaway gap. Okay. Ideally, this gap should stay open. If it's strong, if price is really, really bullish, this should stay open. Now, once this forms, you can start looking for your entry. And since here you have a rather large expansion, you can find your entry within all these displacements by simply using another ICT concept for premium and discount. Measure this range and find your discount gap. Here it is. Okay. Then we have here our entry 1120. You see here in this case that is not a macro window yet, but it's still a very good entry. Okay. Ideally, if you are trading order blocks or changing the state of delivery, you can find your entry here. So you have here the order block, which we trade into rather deep. See here, there is another displacement here. Then we have a market structure shift here above the breakaway gap. So on this candle, when it goes down 1103, when it goes down, this is what ICT advises. Try to put a limit order one tick above the fair value gap, okay, or two ticks, because sometimes it's not gonna go down into the fair value gap. So this way you will make sure that it triggers your order and you're in. Okay, you might have to sometimes you might have to go with a little bit of drawdown sometimes, but many times you also have this scenario where price will just continue up. It will never trade back to the BC. It will just continue up. So you see how it delivers. We have the buy side here, and ultimately we go all the way up here. Sorry. Okay. Now let's see another example. I'll remove the opening range gap. Sorry. Let me just put another. See here, that's the gap from previous day, March 18th. This one we never went back to. It just aggressively delivered down and we consolidated all the way until March 19th. So, I wanted to show you something else about this gap. See how this same gap gave an entry. First of all, the gap, the first presented fair value gap from March 19th here in the afternoon session See that? At 130, we trade into it. Displays up, trade into it. Displays. Here, that's FOMC. So obviously, in a in any other regular day, if there is no FOMC or other news, this gap or these will be entries. But since there is FOMC, you're not gonna take the entry here, just 7 minutes before FOMC, because this week down is going to take you. But FOMC goes down to the gap, fails to on a closing basis to close the gap, then displaces up. So now, since we rejected here and we rejected here, we can use this FOMC gap as an entry to go long. We have relative equal highs here. So when we trade down into this gap, of course, your stop loss have to be rather large. I would advise ideally either below the first presented fair value gap or below the consequent encroachment of this week of the FOMC candle. So this will be your entry here. You will target those relative equal highs. With stop loss, I think below the wick is too much. You can either place it here or slightly below the midpoint of this, something like that. So you usually have with these setups at least 2-3 hour of clean price action before it starts chopping around. But even more, if your overall bias is, look at that, if it's extremely bullish, you can ride this. You can ride this longer term. You can even have time-based exits, but more on that in another time. But also the gap from previous day. Look at that. We displace here at 210 from this gap from previous day, and then we fail to close below the gap and displace again, then trade back into it at 240. This is what I'm telling you. Sometimes even outside of the macro window, there is very good setups. Okay. Of course, you have to have bullish bias here in order to trust it outside of the macro window. And this will be your entry. So this, you have one gap and you have to allow for the second gap also to be traded. So let's say you take it on the initial candle with 230 with a stop loss below the second fair value gap. And your target can be any kind of PD array that you have on the left. I don't know, but I'm telling you, it typically delivers 2 to 3 hours. So even if you manually just put it 2 to 3 hour, it's good enough. Okay. So see how even old gaps, they still deliver. They still deliver this same way. And let me go the previous day. Okay, here. All right. See here, it's a Monday of March 17th. We have the first presented fair value gap. Price goes initially up, then it starts wandering around, goes down back into the first presented fair value gap, but unfortunately closes below it. So we close the gap. And now we start waiting for the setup. Here we displace up, back into the gap, fail to trade below, to close the gap, but we don't displace again. So what do we have instead? We trade down. Okay. Price then starts wandering around. Let me see again the opening range gap. Just to see what we're working with. Sorry, I didn't prepare these examples in advance. I'm trying to do it live with you, so I don't really know what happened here. Um, but let me just cut on the next day. So, and I'll just leave the currents first presented gap. Okay. So we have a very, very small opening range gap, pretty much non-existent. Usually that's a sign for messy delivery during the morning session. So this is exactly what we see here. Okay. And let me check the 15-minute chart. Um, yeah. On the 15-minute, I see an opening range gap from previous day, from previous Monday that was left completely open. So that can be your drawn liquidity for the day. Any other major draw will be these relative equal highs here and the ones below. Okay. And remember, guys, this is draw on liquidity. Doesn't mean it has to trade all the way there during that specific session, but it should draw towards it. Okay, there is another high here, which actually was what stopped the price. Okay, back to the 1 minute chart. So we see morning session. It was rather messy, up and down, high resistance liquidity run from top to bottom. You might be able to find setups here. I personally don't want to participate in all that mess, so I try to avoid morning session when the opening range gap is pretty much non-existent. Okay, let me remove it for now. But eventually we reached this point here, which is 1 o'clock, where we trade above, then displace, and we start spooling up. This can be your entry for 130 spool, but you see, price never trades back down into it. Okay, this is sometimes it's gonna do that, and that's okay. You will just miss an entry, and that's fine. Okay. On days like this, I will typically have no entry, and I'm not gonna trade. I'll just leave it as it is. Sure, it made quite a big run, and it will be nice to participate in it. But if you are using this conservative strategy, um, you would likely miss on such moves. Um, However, you understand the logic now, but there is another thing that I wanted to share with you, and is something that Michael spoke about in a recent lecture of his, and it's the fact that there is more than one significant fair value gap in addition to the 931. Actually, what if I tell you that each session has its own first presented fair value gap that is significant for that specific session and that will deliver price runs for that session? Okay. There is a first presented fair value gap after 930 for usually used for the morning session. There is a first presented fair value gap after 11:30. So, which can be utilized for the launch macro, okay? So 11:30 is here, and we start looking for the first gap. It's this one. You can't miss it. It's quite big. It's there, and you can use that. Remember how the first presented gap after 9:30 didn't give a setup? Well, the launch macro gap did. It did give a setup, and here it is. First presented gap after 11:30. So according to ICT, the launch macro goes from 11:30 to 1:30. So after 11:30, you start looking for your first gap. As we spoke many times here, during lunch, typically we will retrace against whatever move occurred in the morning. So since this was a bearish move throughout the morning, you can all agree that the bears were the ones who made money in the morning. So we expect price to go up. Now, of course, we already have a bullish bias that we established with the 15-minute highs that we marked. And if you're confident that we're going to flip the the day, and this will be the low of the day here, and it's going to go up to the buy side liquidity that we marked, you can also use the launch macro and the first presented gap after 11:30, the same, exactly the same way. You start looking for your setup, okay? Ideally during a macro window. So this is the first significant displacement here. Here. Sure, this one, but this one didn't really leave any significant gaps on the way up. You can argue this one, um, and maybe you can use that, but you have to be a little bit more. Um, you have to be a little bit more careful with your stop placement. Okay, it has to be a rather large stop. Once it displaces again here, you can use this middle gap as it's in a discount for an entry. So you're going to enter around here, which is 1220. It's outside of macro window, so it's not ideal once again. But your stop loss has to be below this first presented fair value gap after 11:30 in order to protect you from all this that will happen during the next macro window. But then what happens during the next macro? Okay, we have a displacement here up again, back into the gap. We fail to close down below this first presented fair value gap with bodies. Okay, the bodies, look at where they are staying. They are reaching the lower quadrant of this gap. If you put the quadrants, you'll see it. Okay, I'll put the quadrants so you can see it. Quadrants. See, it goes to the lower quadrant, but it never completely closes the gap. Only with a wick. And then it displaces up again. Okay. Once it displaces up again, what do we have here at 12? Look, 1248, 1249. This is your macro. 1251. This is the gap you want to be using for entry. Okay. Stop loss will be below the second So you're using the initial gap. You allow price to trade into the second gap. These are the rules. And your stop will be below this candle. We call this below this candle's low. Look at this. 305 is when it starts pulling up. By the way, the first presented fair value gap, by the time we reach this point, this is already a balanced price range. Okay, so because we have bullish delivery, we have bearish delivery, bullish, bearish, bullish, bearish. So we work that gap so many times that we completely balanced it out. And here, when you see price accumulating in the upper half, this signals to you that this range, we're not gonna work around it anymore. This is now balanced and we are ready to shoot off. So using this gap after 11:30, you can find an entry around 1 o'clock and ride all this move to the buy side. Okay. So even if this gap after 9:30 didn't give an entry, this one did. So there are 3 significant fair value gaps during New York. Is the 9:31, is the 11:30 gap, and the one that forms after 1:30. Here after 1:30, this will be your significant gap. But this one we never traded to. Okay. We never traded to this one, so we were not able to use this one in this specific trading session. However, I want to go back and then I'm closing the video. What happened to the charts? Oh my God, where's my chart? Oh, there it is. Okay, I want to go back to March 19th. The previous example that we were looking at. Okay, this is here. Yes, to illustrate the same concept. Remember all this price action. 11:30 is here, and you start looking for your first presented fair value gap after 11:30, and it's here. Let me make it yellow again. I'll extend it to the right. So during lunch, we expect a move against the morning winners. So in the morning, the longs made money. So in the afternoon, we expect, for lunch, we expect a retracement against the people who made money in the morning. And so using the first presented fair value gap after 11:30, we trade through it, back above it, below, above. No displacement so far. There was one here. It was a bullish one, but we never had another one. What happens then? This one is not easy to catch, but we displaced down here. See, displacement. This is your displacement. Displacement, if you are aggressive, you can take this short, or you can wait for another displacement, as the rules say. So trade down, back into the gap here on this candle, then wait for another displacement. Here it is. Here is the next displacement. You have to include the volume imbalance here, and you have to allow, since there is a volume imbalance, you have to allow price to wick through that candle's high, and you cannot be aggressive with your stop. See, you cannot be aggressive with your stop here because of the volume imbalance. So your stop has to be above this candle or above the mid point of this candle, which I personally don't like because every now and then it will take me as well. So above here, you can trade on this candle, which is 1239, or you can use the macro at 1254, 1255, and then it goes down. See how the same logic, even for this gap, same logic works. Displaces down, back into it, fails to trade in the upper half, another displacement. This other displacement is another entry. Okay, 102, 105. This is all macro. And then it starts printing aggressive bearish candles. Okay, all the way back to what? The first presented fair value gap after 930. Here it is. Here it is. And we already discussed the setup that this one gave for a bullish move. Okay, wonderful. So very quickly also to see finally before we close the first presented fair value gap after 130. Let's see if it gave an entry here. So 130, first gap is this one. Isn't this beautiful? Look at this. Market green. Displacement. But then we fail. We fail to stop at the midpoint or above. We actually close completely the gap. So another one. All the way to FMC when we displace up. Then we go down. Remember how I told you you can use this specific gap for an entry based off of the same logic using the 930 gap? Well, knowing that instead of entering here at the top with a very large stop loss, knowing that the 130 gap is in relative proximity, in relative close proximity to this one, you can expect the price to trade back to it, fail to go back to the 931, which it does, and then it displaces. This here is your change in the state of delivery. If you trade that, you can position yourself very early. As soon as we take this volume imbalance, that's also an entry. You can trade here on this down tick after this candle opens right at 209. This is macro. Okay, see how they always form during macro windows, these things. Always. So powerful. Goes up. If you miss it, there's your entry. This gap here. Here, stop loss will be below this candle. See, there is no volume imbalance here, so we are not supposed to trade below this one. And we don't. Okay. And then up into the sky. Okay. So remember, 3 significant gaps, three significant gaps during New York, the one after 9:30, the one after 11:30 for lunch, the one after 1:30 for the PM session. You have to have a narrative. Okay. Lunch and PM are, in my opinion, very often are easier than New York. They might be because you already have some sort of bias that formed during the morning, and the lunch will tell you whether we're gonna flip um, the opening price or not. So if we're gonna flip the day from bearish to bullish or from bullish to bearish, usually you know by the time PM session arrives, you know if the flip will happen or not. If not, you can expect a continuation from the morning move during the PM session. Using the first presented fair value gap of the PM is also very, very powerful because the morning gap will not always give you a setup for the PM like it did here. But one of the three gaps will give you a very, very good high probability setup at least once per day. So this is a way you can trade them, guys, conservatively. There is other ways, of course, where you can catch the initial moves um, before the retracement and the retest of these gaps. But I personally think that this conservative approach is very, very easy to grasp. It's very easy to visually on the charts to see it and trust it. Um, the rules around it are very, very simple. So if you don't see the setup, you don't take it. There is very simple rules. Okay, I'll even list them here for you guys. I'll list the rules. Okay, so let me make it bigger. Rules. First, you have to have a bias. Second, wait for displacement in the for the displacement slash fair value gap through the first presented fair value gap in the direction of your bias. Wait for price to return to the first presented fair value gap and fail to close it completely on a candle close basis or candle body. The next displacement slash fair value gap in the direction of your bias is your entry. That's it. 4 rules. Okay, let me add a fifth one. Ideally, the setup will form during a macro. That's not even mandatory. Okay, these are the rules. Let me make it like this. Okay, these are your rules. Feel free to pause the video type the rules yourself or screenshot this, and then go back test, because the results are unbelievable. The precision is unbelievable. The risk to return ratio of these setups is unbelievable. Okay, it's powerful, smaller stop losses, large return. It's just wow. Okay, so this is it, guys. Let me know if you have any questions or comments. Uh, if you need further guidance or more examples, I'm happy to provide such. And I hope you find this insightful. All thanks goes to Michael or ICT for everything he taught us in 2024 and 2025. Honestly, this is his best work. For me personally, everything started clicking after I studied these lectures, and I can finally see myself getting out of this dark hole of inconsistency and unprofitability. Okay. Anyway, until I speak to you in the next video, I wish you a wonderful day, and I'm out of here.